Hey y'all, welcome back to the channel. So I've been getting a ton of questions lately about home equity options, especially from folks who are either first-time buyers or current homeowners looking to tap into their equity without all the usual headaches. And I get it. The traditional route of credit checks and income verification and monthly payments, it ain't exactly appealing when you're already stretched thin. That's why I started digging into Point Home Equity. And yeah, this thing works in a way I hadn't seen before. We're not talking about your standard mortgage or HELOC here. This is a whole different approach to using your home's value. So today, I'm gonna walk you through exactly what Point Home Equity is, how it works, what it'll cost you, and whether it might be the right move for your situation. Let's dive in. All right, so Point Home Equity, founded back in 2015 out of Palo Alto, came up with what they call a home equity investment, or HEI. Now, this ain't your typical home equity loan where you're borrowing money and then paying it back with interest every month. Instead, here's how it works. Point gives you a lump sum of cash up front, and in return, they get a share of your home's future value. No interest, no monthly payments, no added debt on your books, which means more financial freedom and flexibility for you without the usual stress. Think of it like this. It's almost like Point becomes a silent partner in your home. You get the cash you need right now, and they share in whatever happens to your home's value down the road. You get up to 30 years to settle up, whether that's by selling or refinancing, or you just decide to buy them out early. It gives you plenty of time to plan ahead comfortably. Now, getting started with Point is way simpler than most folks would expect. First thing you do is, of course, check your eligibility and get an initial offer. It takes like a minute, and it's a soft credit pull, so it won't ding your credit score at all. No commitment, just a quick look at what they might be able to offer based on your home and equity situation. It gives you a clear picture in your head before moving forward without any pressure or surprises. If the number looks good to you, then you'll submit a full application online. Super straightforward stuff. They'll ask you to upload some documents and schedule a third-party appraisal to confirm your home's value and lock in that final offer quickly and efficiently. Once everything checks out, a notary comes to you to handle the paperwork, and then the money hits your bank account. The whole thing can wrap up in like 3 weeks, making it surprisingly quick to access your home's equity. But here's the real kicker. You can get anywhere from $30,000 to $500,000 up front, and you don't need perfect credit or even a traditional proof of income. Point works with both primary and investment properties, which is pretty rare in this space, and it adds a lot of flexibility. Here's the kicker. If your home value goes up, they share in the gain, naturally. But if it drops, they share in that loss too. Plus, they cap how much you can owe even if your home value goes through the roof, giving you peace of mind no matter what happens. Now let's talk money, because with any financial decision, cost matters. The good news is that there are no monthly payments with Point. No bills or interest piling up, but that doesn't mean it's free. Instead, you're looking at some upfront costs. First off, Point charges what's called an origination fee, typically between like 3 to 5% of the amount you receive. So like, let's say you're getting 100,000, you'll pay somewhere between 3 and 5,000 from the get-go. Then there's the appraisal fee, which can go up to 1,000, depending on your property and location. These are fairly standard for home equity products, but it's still something to factor in. But here's where Point really stands apart. They don't make money on interest. Instead, they make money by sharing in your home's future appreciation. Sounds fair, right? Well, mostly. To balance their risk, they apply what they call a risk adjustment, which effectively lowers your home's starting value by around 27% when calculating their future share. This helps protect them if the market dips, but it also means if your home value jumps, they can end up with a bigger cut. So even though you skip monthly payments, the real cost depends on how your home performs over time. If your property appreciates significantly, you'll give up a larger portion of your equity when you sell or settle. But if values drop, Point shares in that downside with you. In short, no monthly bills, but a long-term equity trade-off. If you're betting on rising home values, it's worth weighing carefully. By the way, if you're interested in giving Point a try, check out the link in the description. For most products we talk about, we have special deals that you wouldn't be able to get if you went straight to their website. The freedom from monthly payments is huge, especially if you're already tight on cash flow. And the flexibility is real. You don't need stellar credit or traditional income verification, which opens doors for freelancers and retirees, or really anyone who doesn't fit the typical lending box. It's also a great option for those in transition. Maybe you're between jobs, self-employed, or managing irregular income streams. You can pay it off early with no penalties, and you keep full ownership of your home the entire time. It's a way to access your equity without piling on more debt. But there are trade-offs. Since Point takes a share of your home's future appreciation, you could end up owing more if your home value really climbs. That risk adjustment I mentioned, the 27% reduction in your home's value for their calculations, it can affect your final cost. And any renovations you make won't reduce what you owe Point. One more thing, Point's only available in 27 states right now, so depending on where you live, this might not even be an option. When you compare this to traditional home loans, the difference is night and day. Traditional loans mean monthly payments and more debt on your books, which can squeeze your budget pretty tight, especially if you're dealing with other financial obligations like people do, tuition, car payments, credit cards. With Point, there's no monthly payments at all, giving you that much needed breathing room. Traditional loans also always want strong credit and steady income, while Point opens the door for folks with lower credit scores or irregular income, like freelancers or small business owners. And unlike HELOCs or standard home equity loans, this isn't really a loan at all. It's an investment partnership. No interest building over time, no prepayment penalties, and no added stress from fluctuating interest rates. Also, most competitors only work with primary residences, but Point lets you tap into equity on investment properties too. It's a big advantage if you're a landlord or if you're managing multiple properties. It's a more flexible, accessible way to use your home's value on your terms. Point Home Equity offers a completely different approach to accessing your home's value without the usual loan hassles. It ain't perfect for everyone, but if you want to keep control, avoid monthly payments, and have more freedom with your money, it's definitely worth looking into. Just a quick reminder, if you're thinking about trying Point, don't forget to check out the link in the description. Like I said, for most products we talk about, we have special deals that you wouldn't be able to get if you went straight to their website. So what do y'all think? Have you ever tried any non-traditional home equity options? Or are you sticking with the old school route? Drop your thoughts in the comments below. Thanks for watching, and I'll see y'all in the next one.